A sloth, a donkey, and a curious human. Send a prompt and see what they're doing. One hits record with a question on his mind. Two brothers pick it up, see what they find. Corn takes his time, Herman's got the facts. Back and forth, they never hold back. My weird prompts, come on in, that's where we begin. My weird prompts, glad you're here.
This episode was generated using artificial intelligence. Please verify facts.
My Weird Prompts is a community-driven initiative exploring how AI can fuel curiosity and uncover the fascinating ways our world works. GPU compute for this podcast is generously provided by Modal. Learn more at modal.com.
Most people look at a bridge or a water treatment plant and see concrete and steel, but what they should be seeing is a mountain of specialized debt. Today's prompt from Daniel is about the municipal bond market, that $4 trillion engine that actually builds the physical world we live in. Daniel wants us to look at how this functions as a distinct asset class, especially how it stacks up against sovereign debt in terms of risk, return, and maturity. It is a massive topic that sits at the intersection of high finance and your local neighborhood.
I love this topic because municipal bonds, or munis, are often dismissed as the boring, safe corner of the fixed income world, but the mechanics are actually quite sophisticated. I am Herman Poppleberry, and I have been looking at the latest flow of funds data for early 2026. We are seeing a massive shift in who owns this debt and why. It is not just for your grandfather looking for tax-free income anymore. In this high interest rate environment we have been navigating, munis have shifted from a sleepy backwater to a strategic asset class for major institutional portfolios.
It is easy to see why people find it boring on the surface. It is local government debt. It sounds like something discussed at a Tuesday night city council meeting while everyone is falling asleep in the back row. But when you realize this is the primary way nearly every school, highway, and sewer system in the United States gets funded, the scale becomes staggering. We are talking about over $4 trillion in outstanding debt. What makes a muni fundamentally different from a U.S. Treasury bond, Herman? Why do we even need a separate category?
The most obvious differentiator, and the one that drives the entire market, is the tax-exempt status. Under the current federal tax code, the interest income from most municipal bonds is exempt from federal income taxes. In many cases, if you live in the state where the bond is issued, it is exempt from state and local taxes too. This creates a unique demand curve. If you are an investor in a high tax bracket, say 37%, a muni yielding 4% might actually be more valuable to you than a corporate bond yielding 6%. We call this the tax equivalent yield.
Let's pause there because the math of the tax equivalent yield is where the rubber meets the road for investors. If I'm looking at a treasury bond and a muni bond, I can't just compare the numbers on the screen, right?
To find the tax equivalent yield, you take the municipal bond yield and divide it by 1 minus your tax rate. So, if you have a muni yielding 4% and you are in a 35% tax bracket, you do 4 divided by 0.65. That gives you a tax equivalent yield of about 6.15%. If a comparable treasury is only yielding 5%, the muni is the clear winner for you, even though the nominal number looks smaller. This is why the federal government is essentially subsidizing local infrastructure by staying away from the interest. They are making it cheaper for a city to borrow because the investors are willing to accept a lower interest rate in exchange for that tax break.
But let's look at the risk side of that equation. When we talk about sovereign debt, like U.S. Treasuries, we usually treat it as risk-free because the federal government can always print more money to pay its debts. A city or a county cannot do that. They are limited by their actual revenue. Does that put them in a completely different risk category?
It does, but historically, the default rates for municipal bonds are incredibly low. If you compare them to investment-grade corporate bonds, munis have historically been much safer. Even during major economic downturns, the vast majority of municipalities meet their obligations because they have the power to raise taxes or fees. However, unlike sovereign debt, there is a real credit risk. We have seen high-profile bankruptcies in places like Detroit or Puerto Rico in the past. That is why credit analysis is so much more critical in the muni space than in the treasury space. You have to look at the underlying economic health of the specific city or the specific project. You are looking at things like population growth, the diversity of the local tax base, and even the legal protections in the state's constitution.
That brings up an interesting point about the structure of these bonds. With a treasury, you are betting on the whole country. With munis, there are different flavors of debt, right? It is not all just backed by the general tax fund.
You are thinking of the distinction between general obligation bonds and revenue bonds. General obligation, or GO bonds, are backed by the full faith and credit of the issuer. That means the city can raise your property taxes to ensure the bondholders get paid. These are generally considered the safest munis because the city has a legal obligation to use its taxing power to avoid default. Revenue bonds are different. They are backed by the specific income generated by a project, like tolls from a bridge, fees from a stadium, or water bills from a treatment plant. If people stop driving on that bridge or stop paying their water bills, the bondholders are the ones who take the hit, not the general taxpayer.
So if I am an investor, I am looking at a geo bond as a bet on the city's survival, and a revenue bond as a bet on a specific business venture run by the city. I imagine that changes the maturity structure as well. When the federal government issues debt, they have a pretty standard set of durations, like the 10-year or 30-year treasury. How does the timeline for a municipal bond compare?
This is one of the most technical areas where they diverge. Sovereign debt usually uses what we call a bullet maturity. If the government borrows $1 billion for 10 years, they pay interest for 10 years and then pay back the full billion all at once at the end. Municipalities rarely do that because it creates a massive refinancing cliff. They prefer serial bonds.
Serial bonds? That sounds like something you would buy at a grocery store.
Not quite as tasty, but very efficient for a city manager. A serial bond issue is actually a collection of smaller bonds with different maturity dates all bundled together. So, if a city issues $50 million in debt to build a high school, they might have $2 million maturing every year for 25 years. This allows the city to pay down the principal gradually over time, matching their debt service to their annual tax revenue. It is much more like a mortgage than a standard government bond. From a budgeting perspective, it is much safer because you don't have to worry about where you will find $50 million in a single year 25 years from now.
That makes a lot of sense from a budgeting perspective. You don't want a massive bill hitting the city treasury all at once. But from an investor standpoint, doesn't that make the secondary market a nightmare? If I want to buy a specific bond, I have to find the exact maturity year within a specific serial issue.
You hit the nail on the head. The municipal market is notoriously illiquid compared to the treasury market. There are over 1 million different municipal CUSIPs, which are the unique identifiers for securities. Compare that to the relatively small number of treasury issues. Most muni bonds are bought and held until they mature. If you need to sell a small amount of muni debt quickly, you are likely going to take a haircut on the price because there just isn't a deep, high-frequency trading market for a random school district bond from a small town. This lack of liquidity is actually priced into the yield. Investors demand a bit more return because they know they might be stuck with the bond for a while.
So you have lower liquidity, but potentially higher after-tax returns, and a very different risk profile. Let's talk about the projects themselves. We mentioned schools and bridges, but Daniel's prompt asks about the types of projects funded. Is there a trend toward more exotic projects lately?
We are seeing a massive expansion in what I would call non-traditional infrastructure. Traditionally, it was the 3 S's: schools, sewers, and streets. But now we are seeing a massive influx of green bonds and sustainability-linked debt. We actually touched on the logic behind this back in episode 513 when we talked about sustainability bonds. Municipalities are using these to fund things like electric bus fleets, seawalls for climate resilience, and high-efficiency power grids. These projects often have very long lifespans, which fits perfectly with the 20 to 30-year maturity of a muni bond.
I remember that discussion. It seems like the definition of infrastructure is expanding. But I have to ask, what about the controversial stuff? We often see headlines about cities issuing hundreds of millions in debt for professional sports stadiums. How does that fit into the risk-return profile?
Those are almost always revenue bonds, and they are frequently the most debated part of the market. The argument is that the stadium will generate enough economic activity and tax revenue to pay off the debt, but the reality is often more complicated. From an investor perspective, these are often rated lower than GO. Bonds because their success depends on discretionary spending. If a team moves or the economy tanks, Those stadium fees can dry up fast. It is a perfect example of why you can't treat all munis as a single asset class. A bond for a water system is a necessity. People will pay their water bill before almost anything else. A bond for a ballpark is a luxury. The essentiality of the project is a key metric in muni credit analysis.
It is interesting to think about the political autonomy here. In episode 1340, we talked about the power of local government and how they aren't just junior versions of the federal government. Their ability to go directly to the capital markets to fund their own vision is a huge part of that autonomy. They don't have to wait for a federal mandate or a grant if they can convince investors that their local project is viable.
That autonomy is exactly why the customer base for these bonds has shifted so much. Traditionally, this was a retail-driven market. It was the mom-and-pop wealthy individual investor looking for a tax shelter. But over the last decade, and especially as we move through 2026, we have seen massive institutionalization. Banks, insurance companies, and especially exchange-traded funds, or ETFs, have become the dominant players.
Why the shift? If the tax advantage is the main draw, does a tax-exempt entity like a pension fund even want to hold these?
That is the irony. Pension funds and other tax-exempt entities usually stay away because they don't benefit from the tax break, so they would be accepting a lower yield for a benefit they can't use. But for-profit corporations and banks find them very attractive for their own balance sheets, especially when they need to meet certain regulatory requirements for holding high-quality liquid assets. And for the average investor, Muni ETFs have made the market accessible. You don't have to pick individual serial bonds anymore, you can just buy a basket of thousands of them. This has brought a lot more capital into the space, which has actually lowered the borrowing costs for cities. It provides a liquidity transformation where the ETF is easy to sell even if the underlying school bonds are not.
So the democratization of the market via ETFs is actually helping build more local bridges. That is a rare win-win. But let's look at the return side again. When interest rates are high, like we have seen recently, how do munis behave compared to sovereign debt? Does the spread between them stay constant?
Not at all. We track something called the Muni-to-Treasury ratio. Usually, Muni yields are lower than Treasury yields because of that tax advantage. If a 10-year Treasury is yielding 4%, a 10-year Muni might yield 3%. That ratio of 75% is a key indicator of market health. When that ratio gets high, say above 90%, it means munis are incredibly cheap relative to treasuries, and investors start piling in because the tax equivalent yield becomes massive. When it gets low, say below 60%, it means the market is getting crowded and the tax benefit is being priced out.
It sounds like a constant balancing act between the federal government's monetary policy and the local government's fiscal needs. What happens if the federal government changes the tax code? If they lower the top marginal tax rate, does the muni market just collapse?
It wouldn't collapse, but it would certainly reprice. If the tax benefit is less valuable, investors will demand a higher nominal yield to compensate. This is one of the hidden risks of the asset class. You aren't just betting on the city's ability to pay, you are betting on the stability of federal tax law. If we ever move to a flat tax or a system without these exemptions, the cost of borrowing for every city in America would jump overnight. This is a second-order effect that people rarely consider. It makes local infrastructure vulnerable to federal political shifts in a way that is very direct.
I want to go back to the maturity periods Daniel asked about. You mentioned 25 years for a school. Is there an upper limit? Do we see 50-year or 100-year municipal bonds like we sometimes see in the corporate or sovereign world?
They are very rare. Most municipal debt is capped by the useful life of the asset being funded. If you are building a bridge that is expected to last 30 years, you generally cannot issue debt that lasts 40 years. It is a matter of intergenerational equity. You don't want residents 30 years from now paying for a bridge that has already fallen down. Most muni debt falls in the 10 to 30-year range, which aligns well with the planning cycles of local governments. This is a key difference from sovereign debt, where the government might issue a 30-year bond just to fund general operations or pay off older debt.
That seems very responsible, which is a word I don't often associate with government spending. But it makes sense when you realize they are accountable to a local electorate and a very specific set of bondholders. Let's talk about the practical takeaways for someone listening who is looking at their portfolio. If they see the muni to treasury ratio hitting 85%, what should they be thinking?
They should be looking at their own effective tax rate first. If you are in a low tax bracket, the math rarely works in your favor. You are better off in treasuries or corporates. But if you are in the top bracket, an 85% ratio is a flashing green light. It means you are getting almost the same yield as a treasury, but with the added benefit of it being tax-free. It is essentially a free lunch provided by the tax code. However, you must do your credit analysis. Not all municipalities are created equal. A AAA rated state is a very different animal than a struggling industrial city.
And what about the credit side? For an individual, is it even possible to do the due diligence on a small town sewer bond?
It is very difficult for an individual. That is why I usually suggest looking at the underlying ratings from agencies like Moody's or Standard & Poor's, but even those aren't infallible. The better approach for most people is to stick to general obligation bonds from diversified states, or to use a professional manager through a fund. If you are buying a revenue bond for a specific project, you really need to understand the demand for that project. Is that toll road actually going to see the traffic they are projecting? We have seen many toll road projects go into default because the pro forma projections were too optimistic. That is where the risk lives.
It feels like the muni market is a perfect reflection of the American experiment. It is decentralized, it is tied to physical reality, and it relies on a complex web of local and federal cooperation. It also dictates urban development. If a city can't get a bond issued, that new suburb doesn't get built. The financing literally shapes the map. Before we wrap up, what is the one big change you see coming for this asset class in the next few years?
I think we are going to see a massive increase in private-public partnerships, or P3 structures, being funded through the muni market. We are seeing cities partner with private companies to build things like high-speed internet networks or water recycling plants. The debt is issued by the municipality, but the project is managed by a private firm. It blurs the line between a corporate bond and a muni bond, and it is going to require a whole new level of expertise for investors to price that risk correctly. It is also a way for cities to get around debt limits. If it is a private partner's responsibility, it might not count against the city's credit ceiling.
It is the ultimate hybrid. But as you always say, there is no such thing as a free lunch in the credit markets, even if the tax code makes it look like there is. Rating agencies are getting much smarter about looking through those structures to see where the ultimate liability lies.
If the city is ultimately on the hook if the private partner fails, the rating agencies will treat it as city debt. The transparency in this market has improved significantly since the financial crises of the past, but it still requires a sharp eye.
Well, this has been a surprisingly deep dive into what I thought was going to be a dry topic. Daniel always has a way of pointing us toward the underlying mechanics that we take for granted. It is wild to think that the very road you drive on is essentially a manifested piece of the fixed income market.
It really is. Every time you pay a water bill or a toll, you are participating in the cash flow cycle of a bondholder somewhere. It is a very direct connection between finance and the physical world. We have covered the risk-return profile, the serial maturity structures, and the shift from retail to institutional investors. The muni market might be boring on the surface, but it is a $4 trillion powerhouse once you look under the hood.
We should probably mention that if you want to dig deeper into the political side of this, episode 1340 is a great companion to this discussion. It explores how that financial autonomy translates into real political power. And if the green bond aspect caught your ear, episode 513 goes into the specific logic of those sustainability-linked structures.
Both are worth a listen if you want to see how these financial tools are being used to shape the future of our cities. I could talk about yield curves all day, but I think we have hit the essential points for Daniel's prompt.
Thanks as always to our producer Hilbert Flumingtop for keeping the gears turning behind the scenes. And a big thanks to Modal for providing the GPU credits that power this show and keep our research capabilities sharp.
This has been My Weird Prompts. If you are enjoying these deep dives into the plumbing of our world, a quick review on your favorite podcast app really helps us reach more people who care about these details.
You can find us at myweirdprompts.com for the full archive and all the ways to subscribe. We will be back soon with another prompt.
Goodbye for now.
See you next time.
This episode was generated using Gemini Flash 3. Text-to-speech engine was Chatterbox.
Thanks for listening to our show, my